Mid-cap funds are on an average down by 10% in the last 1 and 3 months. Small-cap funds are down by 14% in 1 and 3 month periods. The broader stock market index, Nifty 50, that represents the country's biggest 50 companies, is down by 7% in the last 6 months. So obviously, new investors are worried that they will lose money if they start investing via systematic investment plan or SIP in mid or small cap funds in such a market. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of investing and personal finance. So if you have been worried about market highs, crashes and volatility, stick around because we have got some eye-opening insights backed by 20 years of market data. Motilal Oswal AMC conducted an in-depth analysis of 20 years of market data. They studied the performance of SIPs over all the possible 5-year, 7-year and 10-year periods across large cap, mid cap and small cap indices since 2005. So the numbers are totally unbiased. The time period considered included major market crashes like 2008, 2013 and even the COVID-19 crash of 2020. The results? Fascinating to say the least. So let's look at the results starting with the 7-year SIPs. Now, many believe that starting a mid or small cap SIP during market lows could be risky. But what does the data say? Look at your screens. Here's how 7-year SIPs have performed since 2005 over every possible 7-year period. So you can see that large cap SIPs almost never lost money. Mid cap SIPs had 0 instances of negative returns. And while small cap SIPs had a 5.8% probability of loss, they still delivered an average return of 12.7%. That's impressive, right? But there's more. Now let's focus on minimum returns here in the table. So let's say you started an SIP and after 7 years, the returns are negative. Let's see what happens if you don't invest any fresh money and just stay invested for 1 more year. That is 1 extra year. The results will surprise you. So you can see that for large cap Nifty 100 index, returns at the end of SIP were minus 0.8%. But if you stay invested for 1 extra year, returns change to amazing 15.1%. Similarly, in case of mid cap, that is Nifty Mid Cap 150 index, returns at the end of SIP were 0.4%. And 1 extra year of remaining invested changed the returns to 20.4% after 1 year. Moving to small caps, that is Nifty Small Cap 250 index. So the returns changed from minus 7.3% to 14.8% after 1 year. This highlights a golden rule of investing. Time in the market beats timing the market. If you can weather short-term volatility, the rewards are significant. Now we saw how 7-year SIPs have functioned for investors in the past. Now what about shorter SIPs? Many new investors think 5 years is long enough. Well, the data says otherwise. Again, look at your screens. So as you can look at the data, minimum returns in case of large caps have been on an average around 5.9%. In case of mid caps, minus 8.4% and minus 18.2% in case of small caps. So shorter SIPs are more volatile, especially in small caps where probability of loss jumps to 11.7%. While the average returns are still strong, shorter durations come with higher risks. This is why staying invested longer makes all the difference when you are investing via SIPs. So let's look at what happens if we invest for a longer term of 10 years. SIP for 10 years. These are almost bulletproof. Look at the data. Large and mid-cap SIPs have never lost money over a 10-year period, while small caps have only 0.8% chance of loss. Even in the worst case scenario, small cap SIPs had a loss probability of only 0.8% over 10 years. So, the data proves that the longer you stay invested, the more insulated you are from volatility. But why do long-term SIPs work? Well, patience pays. So, what does all this data tell us? SIP investing is a long-term game. Market volatility can shake your confidence, but reacting emotionally can lead to missed opportunities. So to answer your question, Will you lose money in small or mid cap SIPs given the current market conditions? Is it a wise decision to stop or not start investing because the markets are down? Well, this couldn't be true for SIPs. The real winners are those who stay the course. Whether it's large cap, mid cap, or even small cap SIPs, the evidence is clear. Patience and consistency pay off. To sum it up, SIPs are resilient even during market crashes. Longer durations reduce the risk of losses dramatically. Timing the market does not work, staying invested does. If you have been second guessing your SIPs, let this data put your mind at ease. Remember, investing is not about timing the market, it is about time in the market. If you found this video helpful, don't forget to like, share, and subscribe to our channel for more insights on investing. Got questions about SIPs or mutual funds? Drop them in the comments below. Thanks for watching and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.